PCE inflation report update. It is 10:05 a.m. Eastern Time, May 31st. I'm Rich Posh for Critical Point. We're applying the business cycle modeling to a specific fundamental that's an input for our economy and stock market forecasting, tracking, trend following, timing. The report this morning was for April. PCE inflation came in at 2.7% headline, meaning all inclusive, then 0.3% for the month-to-month rate, whereas the other one was an annualized rate as of April. Both those numbers came in as anticipated by various pollsters, and apparently the stock market was in line with the pollsters too. The stock market hasn't done much. And for those of you who are subscribers, what we're seeing with this inflation report is it's supportive of what we anticipate for fluctuations in the next week or two, as well as fluctuations for the month of June, July. And how does that tuck into the market for this year? If you're not a subscriber, get on board. Go to criticalpoint.podbean.com, B-E-A-N, Bean, okay? And you'll find free and locked up, mostly locked up. You can find a place to sign up, and that you got a 2-week free trial, basically, if you cancel soon enough. And it's recurring. However, you can cancel at any time. And my guess, you give it 3 months, you're going to be with us for the rest of this decade. Fantastic journey going on here in financial markets, commodity markets, the economy, our society, climate, and it just goes on and on of all the things we offer, okay? But we have a primary focus on the stock market and economy. All right, here we go. This is the annualized PCE, a measurement that comes out at the end, near the end of every month, and the Fed Reserve prefers that over the CPI inflation report that comes out around mid-month, okay? Wall Street tends to be more on the CPI, most people CPI, but everybody watches the PCE because they're aware of the Fed Reserve prefers it. Well, this has been updated as of this morning here on the month-to-month type of situation here of return. And what we have is that the market, I keep calling the market, the PCE inflation at 0.03%, okay? What we have is that it looks normal. It's calmed down. It's in the normal range that goes all the way back to the 1980s. I'm sorry, 2000s, okay? So I've been saying this for quite some time. We're back to normal economy relative to the month-to-month inflation. There's nothing to get scared about, worried about. We'd like to see it dip at times, okay? But it is what it is. It's there. It's working. Now, applying the business cycle, what we think is there's a kitchen business cycle that lasts about 3 to 4 years, and quite a bit of the business statistics data, the economy, the stock market. It's shorter than what Mr. Kitchen actually discovered. He discovered it in business inventory. I've learned it's a type of cycle. It's almost in anything and everything in life. It goes beyond the markets and business. But at any rate, I think I have a better definition, can time it a little better. And I believe what's going on is that the inflation should be peaking now in the next few months here. And it's really should be heading lower into next year. If I'm wrong on that, the timing would really be just a little different, that it just goes lower into this fall months. So I just see very, very little risk of higher inflation for the remainder of this year. It ought to be going lower. The month-to-month may not go any lower than what we're looking at here with this range. It may be stalling out and boring, but we want to see the annualized working lower just so the Fed Reserve doesn't cause problems for us relative to interest rates. So now we will go to the annualized. And this is the annualized, so it's 2.7% as of April, okay? And we can see for this annualized, and this is also an annual chart analyzed because it'll change over time. What we can see is this is pulled down, and it's due for that little K there, is it's due for a kitchen business cycle top, all right? We've also recently seen a kitchen business cycle top in PMIs and primarily ISM version of PMIs that gives a clue of GDP. It has not been a good clue for about 2 years now. Worst performance since 1950 are correlating, but it's probably getting back in line. It has peaked and is going to erode a little bit and stall out for a while, and that's normal behavior during a decade for economic growth. During a juggler business cycle, when the economy grows for 7 to 12 years, and then we have recessions for 1 to 3 years, and much shorter than that these days. At any rate, I think that Kitchen being rather bearish now in the next year in PMIs, but really what it's going to do is just trade sideways. It's not going to show us a robust economy. What it really is showing, we are slowing down the economy. We are getting it back to normal. And what that should help to do is also ease inflation back. So I think the two are working together. Now, that may concern the stock market on a very short-term basis at times, that maybe we slow the economy too much. But overall, I think the stock market's going to appreciate a little slowing down of the economy. It's been running hot. And they'll obviously appreciate it if we have an easing of inflation, because then the Federal Reserve will leave us alone and actually lower interest rates. And I think they lower interest rates later this year into next, but it's going to be a while yet. And I'm fine if they never lower interest rates. I think we need to grow up and get over it, not worry about it, because really these are normal interest rates we've seen over the past 100 years, and the economy grew well, stock market did well, country went on, there was no end of world scenario, okay? But nevertheless, the market is sensitive to interest rates, still a little less so, stock market that is. And some people say inflation is lower than what the government's been saying, and they've been saying this for quite some time. At any rate, I do think we're going to see it erode lower, but I think it's going to be a slow, quiet process back to 2% for the Federal Reserve. Not necessarily a big deal, but at least we're at 2.7%. We should be less worried, less concerned. The Fed should be less. But as long as they see strong jobs as well and good pay, they'll be concerned something can tick up. And commodities would normally tick up in prices during the summer. That may help support inflation. But I think there's so many other sectors within that inflation group, if you will, the calculation inflation, that are coming down. It's probably going to offset it. I don't think we're going to have big explosive moves in commodities other than maybe the grains. And I think the marketplace will be smart enough, our economy, our people smart enough to know that's just one little thing off on the side. Don't worry about it. So our best forecast is this is working. Inflation was kind of transitory somewhat. And inflation isn't going to do a whole lot for a few years here, should ease back. And our forecast is we might see a spike in inflation near the end of the decade, and that can just coincide with peak economy. There used to be a rule of thumb in prior generations to always assume higher inflation near peak of the economy, then higher interest rates, and then the Fed would break the economy, or we'd break it ourselves, and down it would come. All right. Well, these days that theory doesn't work. We don't always have high inflation at the end of the decade. But this time around, I'm willing to allow for it. But that does not mean anything this year and next. It looks like inflation is stalling out at least. And some people on the Federal Reserve side would like it lower still. It may be a struggle to do that. And maybe that'll be a problem for us or in the stock market at times and interest rates. But in general, I think it's working. I think it's working just fine. Inflation will continue to erode. These business cycles are still working, just like for the history of this country, and we even find evidence in other countries. The same cycles worked for quite some time. Over in the commodities, we have 800 years of history and find the super long-term and major long-term cycles still work today in terms of how we do supply and demand, and that's a clue also of how we run our economy. This business cycle model is on top of it. Join us here for a great journey this decade here of the pluses and minuses in the markets and the economies and all the little twists and turns, because this modeling helps us with twists and turns every few hours, days, months, weeks, whatever, but it also helps us with the years and what's going on. I have a once a decade buy sell signal in the stock market when the stock market goes up 100 to over 400%. It's been up over 100% already this decade. Then once a decade, it drops minus 20 to minus 50%. And if there's a super cycle, it can drop more than that. Get on board with us. Get on board. Look at some of the commodity stuff, gold, oil. Look at the economy, grains. Look at the bond market, interest rates. But definitely get on board with our stock market. That's our primary focus. And inflation is just one little component of that, and it's less important right now, but we're still going to be updating it tracking it. It's still an input to our economy and stock market modeling. Past results are not necessarily indicative of future results. You can also go to criticalpointpod.com for a website about myself and modeling, and there are links to go over there to get the free videos and audios as well as to sign up. Thank you.